When you hold your savings in cash or low-yield accounts, you are quietly paying a steep price. Inflation constantly eats away at what your money can actually buy, turning your hard-earned principal into a shrinking asset. Bank CDs offer the comfort of guaranteed safety, but at today's rates of around 4.0 to 4.3%, that safety comes at a high cost. Those returns often barely keep your head above water when compared to baseline inflation, and that's before the IRS takes its cut. Every year, you pay taxes on the interest a CD generates, even if you don't spend a single dollar of it. This annual tax drag pulls your actual return down even further. If you rely entirely on the traditional banking system to protect your nest egg, you are backed into a corner. You end up trading real growth for a false sense of security, quietly accepting slow, guaranteed losses in purchasing power over time. To actually preserve your wealth, you need a different tool. You need a financial vehicle that directly balances the low-yield problem and the annual tax penalty at the exact same time. That tool is the Multi-Year Guaranteed Annuity, or MYGA. You can think of it as the insurance industry's version of a CD, engineered specifically to protect your principal while guaranteeing a fixed rate of return. This matrix shows the difference in yield capabilities. On the left, top bank CDs max out around 4.3%, and you pay taxes on that growth every year. On the right, a 5-year MYGA guarantees between 5.6 and 6.3%, and growth is tax-deferred. Securing that extra 1.5 to 2% advantage requires a specific commitment. You have to be willing to follow a strict set of institutional rules and accept real limits on how quickly you can access your total balance. MYGAs are not a high-yield loophole. They are rigorous financial contracts. If you have to discipline to hold the contract to maturity, you are rewarded with clear mathematical superiority. The first rule of a MYGA is time. You must commit your capital to a fixed contract for a specific term, which typically ranges from 3 to 10 years. In exchange, the insurance company locks in a high guaranteed interest rate, shielded entirely from stock market crashes, bond market volatility, and economic downturns. The main trade-off for that stability is access. During your chosen term, you forfeit the ability to withdraw 100% of your principal on a whim. However, you aren't completely cut off from your money. Most MYGA contracts include a built-in relief valve, allowing you to withdraw up to 10% of your account value every year without paying a penalty. But if you break the rules and pull out more than that 10%, you'll face surrender charges that often start between 7 and 10% in the first year and gradually decline over the life of the contract. Because of these strict rules, MYGAs should never be used as a checking account or an emergency fund. They are strategic vehicles designed for planned, long-term wealth preservation. Let's look at exactly how the non-qualified tax-deferred structure changes the math, using a baseline scenario of a $100,000 deposit earning a flat 5% interest rate over 10 years. This graph plots the 10-year test. If you put this money in a standard bank CD, you pay taxes on your interest every single year. That constant drain stunts your compounding power, leaving you with roughly $145,000 after a decade. Put that exact same money at the exact same 5% rate inside a MYGA, and the dynamic changes entirely. Your interest compounds without tax interference year after year, driving your final balance to nearly $163,000. That creates a gap of nearly $18,000. You didn't take on more market risk, and you didn't need a higher interest rate to get it. That advantage comes purely from the tax-deferred structure. To maintain this advantage, the IRS imposes 2 specific constraints. First, if you withdraw your gains before you reach age 59.5, you will face a 10% early withdrawal penalty. Second, MYGAs operate under a last-in, first-out, or LIFO tax rule. This means when you finally do make a withdrawal, the taxable interest comes out first before you can touch the untaxed principal. When used correctly, tax deferral operates as a secondary engine of compound growth. Over time, it significantly widens the performance gap between an annuity and a fully taxable bank product. Moving large sums of money out of a familiar local bank and into the insurance sector can feel like a major psychological leap. This shift moves your capital into the institutional market, where yields consistently exceed what retail banks can offer. The explicit trade-off here is that by leaving the bank, you forfeit federal FDIC insurance on your deposited funds. Instead, your principal is backed directly by the financial reserves of the issuing insurance company, which is heavily regulated and audited by state insurance departments. Because you are relying on the company's financial strength, consumer safety requires discipline. You must filter your options, only purchasing contracts from highly rated carriers carrying an A- or better. Protecting your safe money outside the banking system relies on stringent carrier quality rather than a federal stamp. Without that federal backup, selecting a top-rated institution is the only way to ensure principal security. There is one final risk to address with guaranteed products: the interest rate lock. If national interest rates rise sharply while you are 5 years into a 10-year contract, you cannot capture those higher yields. The specific structural solution to mitigate rate lock while simultaneously creating predictable cash flow is called the MYGA ladder strategy. This chart shows how a ladder works. We take a $300,000 lump sum and divide it evenly across 3 separate contracts: a 3-year, a 5-year, and a 7-year MYGA. When that first block reaches the 3-year mark, the contract matures. This creates a massive, penalty-free liquidity event where you can withdraw cash if you need it. If you don't need the cash, you reinvest that block into a new contract at current market rates, allowing you to capture potentially higher yields over time. The trade-off is that laddering requires active portfolio management, and it prevents you from committing your entire lump sum to the absolute highest single rate available today. By staggering your maturities, a ladder strategy transforms a rigid contract into a dynamic, rolling system for steady income, predictable liquidity, and optimized growth. The ultimate takeaway is clear: MYGAs offer better mathematical returns for wealth preservation than CDs, provided you don't require immediate access to every dollar of your capital. This makes them an ideal fit for pre-retirees within 5 to 10 years of retirement looking for a tax shelter. They are also highly effective for current CD holders frustrated by low returns and those looking to perform tax-free 1035 exchanges from older, underperforming annuities. Conversely, you should avoid MYGAs entirely if you are under age 59 and a half, or if your financial situation means you might require the immediate liquidation of your entire balance for an emergency. The final variable to navigate is the market itself. Optimal MYGA rates fluctuate daily and depend on your state of residence, specific carrier ratings, and your exact premium amount. First Freedom Life is dedicated to helping conservative savers cut through this complexity and secure the highest possible safe yields for their specific timeline. We offer a free 30-minute discovery call with a licensed agent. We'll compare current rates from top-rated carriers, calculate the precise tax deferral advantage for your tax bracket, and design a custom ladder strategy built around your goals. There is zero pressure and zero obligation. Book your personalized, safe money discovery call today at firstfreedomlife.com.